Welcome to the latest episode of our podcast series for financial advisors. Today's episode is Running It Back, What It Takes to Build a Multi-Billion-Dollar Firm Twice. It's a conversation with John Krambeer, the founder and CEO of Validus Capital. I'm Louis Diamond, and this is the Diamond Podcast for financial advisors.
At Diamond Consultants, we help elite advisors identify the right environment for their businesses to thrive, whether that's at a wirehouse, boutique, or independent firm. With nearly 3 decades of experience, we've guided thousands of advisors and represented more than $250 billion in assets transitioned. And each year, 1 in 4 advisors managing $1 billion or more who change firms are our clients. Our process is education-driven and based on building relationships, starting as your strategic partner well before you're even thinking of a move. To schedule a confidential conversation, call us at 908-879-1002. Wondering why advisors change firms and where they're headed? Are transition deals going up or down? Those very questions and more inspired us to create our annual Advisor Transition Report. It's the award-winning, data-driven resource designed for advisors that connects the dots between the motivations around movement and the firm's appetite for top talent. Arm yourself with the knowledge you need to make smart decisions. Download your copy at diamond-consultants.com/transition report.
Some advisors break away once in their careers. John Krambeer has done it twice, each time building a multi-billion-dollar RIA. That kind of repeat success is rare in any business, and in wealth management, it's almost unheard of. Yet John's journey offers a front-row seat to the evolution of the independent space from its early pioneering days to the sophisticated and bespoke multifamily office models we see today. Long before going independent was fashionable, John left Merrill's private banking and investment group, or PBIG, in 2004 to launch Candid Capital. He was early to the RIA movement, betting on transparency, better reporting, and access to private investments at a time when few advisors dared to break away and forge their own path. In 2022, John made the difficult choice to leave Camden and do it all over again, this time building Validus Capital, now a $2.5 billion multifamily office designed with hard-earned lessons in mind. In our conversation, John shares a candid look at what it was like to break away in the early 2000s when platforms and support for independence were still in their infancy, why he walked away from the first firm he built, and what drove him to take on the challenge a second time, the choices behind building Validus Capital today, from private markets to family office services, the hard lessons of growth, including what he wishes he had done differently the first time around. It's a rare opportunity to learn from someone who not only helped shape the independent space, but has proven that with clarity, conviction, and the right people, you can build lasting success more than once. So let's dive in. John, thanks for spending some time with us today.
We're excited to be here. Thanks for letting us have the opportunity as well.
By all means, we met not that long ago, but as I heard your story, heard the inputs of what got you here, I knew we had to have you on the show. So let's jump into it.
Thank you so much.
Why don't we start at the beginning? Tell us about yourself and how you came into our wonderful industry in the first place.
Well, it's a fun story. I was just back visiting where I grew up this weekend in the Midwest, Northeast Iowa. Grew up on a family farm. Learned a lot about work and tenacity and the challenges of Mother Nature. It was a great place to grow up. As I was finishing high school, I thought maybe there was something else out there and what other opportunities might exist. And fortunately, my parents were accommodative and helped me get to the West Coast and dropped me off and let me find my way. The story started in the Midwest, and I was really fortunate when I landed here and arrived. This is 1986. So I wasn't quite sure of the path at that point, other than I was a little tired of milking cows. I got my butt into school, started studying finance. I went to a small university called Woodbury, which is a unique school here in Los Angeles that's been around for a long time. What was so unique about it is it allowed you to work or allowed you to have the opportunity for an internship in my sophomore year. That is really where this story starts. A friend of mine said, why don't you call all the investment banks and just see if you can get an internship? So I did. I called them all. And the only one that answered me was Merrill Lynch in Pasadena. It was a guy named Bob Solomon. And he said, send me your resume. I said, Bob, I don't even know if I have a resume. I basically went to high school, I farmed, and I'm a young kid starting out in college. I've worked a bunch of jobs, but he said, just put that down and send it to me. And I started going, got some credit at school, and that was the start. It was 3 months, I believe, met a bunch of great people. And a couple months after I'd left that internship, they called me and said, hey, would you be interested in becoming a client associate? You already know more than anybody else we're hiring. And I said, I think I could do that. And so I went to school in the afternoons and finished up at night. And I basically started working full time at Merrill.
Wow.
I was just turning 19. This was probably 88 maybe, because I was second, third year in school. And the story took off, and I got to know the business, graduated college in 91. At this time, there were no teams. This wasn't a period where there was these amazing 10 people operations. They were a stockbroker, maybe an associate that worked for a couple, and a very shared platform in terms of support, but really just a single advisor handling a small amount of clients back then. So I didn't really know the next step, but I got lucky and transitioned from Pasadena to Beverly Hills. And there I met a guy named Nico March. He was a partner of the firm when Merrill was a partnership. He retired on my watch after 52 years. This started a unique relationship, and I became a member of his team. This was the start of this senior advisor with a young advisor and maybe one or two assistants. The 90s were an interesting time. We started working together, built a great business, and the chapter turns over a couple more times, but I know we'll talk through that. But that's how I got to the financial industry and the services business. And I haven't really looked back. I always joke, I've either milked cows my whole life and I've been in the financial services business. I'm not sure which is easier. Sometimes milking cows.
I know which one's more lucrative.
They're both a lot of fun, but I've been really fortunate I think from the beginning, I was very fortunate to have good people. It wasn't without some challenges and some tough periods, but just good people at the beginning of my career that really helped shape where we are today.
Amazing. Thinking back to the 80s or early 90s as you first became an advisor to where you are today, what's one belief you held early that you've since changed?
The industry has changed so much, and obviously so much for the better. And that has come through the tech bubble. It's come through the financial crisis, but the industry is just so much better for our investors and the fiduciary standard that we now carry. But, when we started in this business, we were stockbrokers. We were kind of investors or transaction advisors. And in those early days, you owned maybe 5 or 6 stocks, and you owned maybe one mutual fund or one product, and maybe sold it. At that time, products were starting to unfold into the ecosystem of traditional Wall Street. And that belief early on was this is how it was done. And maybe today we have that kind of concentration again at a peak market, but that belief changed obviously through some really difficult periods. The tech bubble, the financial crisis, obviously COVID. We've been through some dramatic drawdowns, and certainly none harder than probably going all the way back to the 99, 2000 tech bubble. And so it's changed to where today we spend so much time on the human capital side. We spend so much more time on the governance side. So that belief that my value was because I was able to buy some General Electric at 30 and sell it at 40, that's changed. We today have these deep trusted relationships that I talk with my dad occasionally. It's very similar to the way a farmer cares for his land and cares for his livestock and cares for his way of life. This business is at times we have to trim and prune and think about reallocation and think about risk and think about opportunities. And all of that kind of ties together of just how we've changed in the way we support and the way we work with our clients today.
Well said. It is a big shift from just being like the idea guy and being like known to do one thing to having so much more responsibility and accountability to clients and obviously to your team as well.
Absolutely.
So we'll spend a lot of time in this episode talking about Validus, your current firm. So maybe just to set the stage a bit in chronological order, we'll talk about your time at Merrill in more detail, when you went independent for the first time, et cetera. But just to set the stage, what is Validus today? If there's any metrics you can share, the size of the business, we'll get into the value prop and everything, but maybe just to frame it, let's share with the audience why you're credible to talk with them today.
Yeah, today we're a $2.5 billion multifamily office platform. We've got 15 team members. This has taken years, but we've built this off a foundation of exceptional service, planning, investment management, and we evolved over the years, which I think we've been certainly early on, which was the private alternatives platform. And then this next stage of our business, due to complexity, is delivering a family office solution. So that's where we are today. And it's been a lot of fun to be a part of that growth over these last now 10, 15, 20, 30 years.
Amazing. So let's rewind the tape here. Let's go back to the Merrill days, where at the time you're in the private banking and investment group, or PBIG. Now I think it's Merrill Private Wealth. They've changed the name, but essentially the ultra high net worth segment of Merrill that has been still to this day an incredible reputation.
Absolutely.
If you think back to it, what's a habit or two that you picked up while you were a PBIG advisor that still shows up today with how you run Validus?
This kind of goes back into how we, certainly being around good people, having that mentorship from Nico and spending the 90s, we got through as Merrill and certainly other firms, but Merrill started to think about private wealth and started hiring teams from Goldman and JP Morgan. That was the first, and I know exactly the two first teams they hired. Though at that time, Nico and I were certainly one of the larger teams in that complex in Beverly Hills. And I called them the Goldman or the JP Morgan teams. They were peers. They were guys we were getting to know. And so this was probably the late 90s where one of those teams, which was transitioning from Goldman, which is certainly more boutique, to a larger platform like Merrill, where it felt probably a little bit overwhelming. It probably felt a little bit lost. And having been farm raised, the conversation began with, how could John maybe help us navigate this larger platform of Merrill Lynch versus where we used to at Goldman Sachs? And so in the late 90s, we merged our business into a group with some of the Goldman Sachs team members. That was probably the lever that I needed to have the skill set be around that period of growth and change in our industry that allowed us to think that we were capable and believed in ourselves to eventually get to independence. And so that was a very key period as we led up to the first breakaway in 2004 when we put a flag in the ground and started what was Camden Capital. That was an exciting time, but it was one, if I think about the combination of that old guard, early stockbroker, advisor, transitioning to fiduciary, the stewardship role we play today, as I started to be surrounded by other very strong, certainly high skill set advisors.
Yeah. It sounds like too, maybe it gave you a taste of what it was like to be part of a team. And instead of just being a solo guy and working with one partner and being transactional, it was, this is what we can accomplish if we work together and we all have different skill sets.
And I'd say that might have been one of my weaknesses, because I was probably a little bit too, even though I had that team member in Nico, he was obviously getting toward the end of his career. And so it really was still a one-man shop. And I was young. I probably started believing a little bit too much sometimes of just my importance. As we transitioned into the team and really started to think about teams as 3 or 4 or 5 and 10 and 15 and 20, that was challenging for me a little bit, to just know that I could trust and lean on other people to help us pull that wagon and deliver what we're trying to do for clients.
Well said. Well, I got to ask, what was it like working for Merrill back in the 90s and early 2000s? So many people I talk to talk about the golden years and what it was like back in the day and what it was like working for Merrill before the financial crisis, before Bank of America. But just in general, I have to imagine it was a fairly different environment back then, certainly than when you left and certainly than now. So
absolutely.
How would you categorize it?
Well, it certainly was a very fun and exciting time. It probably was a little bit Wild West almost. And I would say that Wall Street it's been demanded of them. The independent space where we sit today has pushed it Obviously, some of the guys that started businesses in '04 when I was starting mine have had success with their business models. And that has put pressure certainly on the deliverables and what clients come to expect. And so I think back, and this all history does repeat itself. We think back to the 90s. We started with pretty well diversified portfolios in the early 90s. And by the end of the 90s, we were concentrated in, at that time, the top 10 market cap companies, very similar to the way we are today. Now, businesses are totally different. Apple, Microsoft, Meta, these are exceptional business models with very deep treasure chests of cash and balance sheet strength versus some of the weakness or maybe lots of the weakness that we had in similar businesses back in the late 90s. So the products, just there wasn't the alignment that we see today across our industry. So those are things that, while it was a fun period to be an advisor and be a broker on those platforms, it was exciting. The challenges were, which is how we got to this part and how many of the leading teams have since left and started their own businesses. It was really this, how can we be more transparent? How can we be better at how we think about reporting? And remember, back in the late 90s, early 2000s, there wasn't a model or a platform for us to deliver comprehensive reporting to a client. You got a statement, maybe you built something on your own, but there were so many challenges on how you can really start to integrate all of the things that you were starting to do. And this took leaps after the financial crisis, at least as we think about independence. The financial crisis was very painful and it was certainly a terrible time, but it did really start to spur the growth for sure for our business and certainly others as we came out of that. We saw some of our competitors go away, unfortunately, and setback for others allowed Schwab and Fidelity to really start to take a hold on that independent, being a trusted custodian and allowing individuals and advisors to start thinking about how they could compete, which before that, the brands that we all still remember, the Merrill Lynch Bull, that was a brand you could lead with. It started to just not have quite that impact as we went through those unfortunate times.
Yep. Yeah, I don't disagree with you. We often say that's where you can trace the pickup of the independent side, aside from technology and platforms, but it was just the realization that you didn't need the biggest brand in the world on your business card to be successful. You broke away to start Camden in 2004. So let's go back to that time. You mentioned some of the seeds of doubt that you had about operating the type of business you did on a wirehouse platform, the lack of transparency, the lack of quality reporting, et cetera. Were there other things that motivated you to not take the easy path, which was staying or doing what most people did at the time, just going to Morgan Stanley or Smith Barney or Wachovia, et cetera?
Having that opportunity to be around some of those individuals that came over onto the Merrill platform, there were already some independent firms. Blair was out there and had some tremendous success, guys that had left Goldman. There were some platforms that were already certainly ahead of the times, but we were really starting to think about that and ponder what would it be like if we actually could move from here to there and really start to think about how are we going to report? How can we think about access differently? The day we wanted to call, and whether it was just simply getting a mortgage or trying to put a more complex derivative contract in place to help manage risk for a client, there are days where Merrill didn't want that risk. And if you were a captive advisor, no fault to anybody, you just weren't going to be priced in the same way, or maybe priced a little rich relative to where Goldman or maybe Credit Suisse or some of the other firms might be. And so we started to just think about those building blocks. And the opportunity came, and looking back, it was hard. This was pre-financial crisis. It was still cool to be at Merrill or Bear or Lehman. We actually started, I custodied at Bear because I still had a legacy brokerage business, which meant it was a transaction business that was still important to some of those types of clients. Plus, as a client didn't understand the value prop in, I'm going to work for basis points, because they only felt like we were there for the transaction. We hadn't built that brand yet, that value add. And so that transition at that time was extremely difficult. So we went to Bear first. Fortunately, after a year, I said, you know what? I'm going to focus completely on the independent wealth management. I'm going to be a fiduciary. This allowed me, and Schwab was over here in my ear. There was a guy named Sean Mihal, and Sean's still around. He's over at Fidelity today. And Sean called me. He was early in the business. He's like, listen, come over here. You can do it. And I'm like, gosh, I remember talking to my wife. We're going to go to fee only. I think the first year we did 43,000 in revenue. It was a challenge. And we started Camden with 23 million, just about enough to be an SEC registered investment advisor, and which at that time was 25 million. And I think you had 6 months to get there. And obviously we did that and we started moving forward. The one thing I was doing then, which Lydian Wealth was out there, it became Fortigent, some of the Scott Welch and some of the early guys, we got connected with them and used their reporting. And that's what we led with for those first couple of years, was just going to a guy who had assets at Merrill and Goldman and said, hey, listen, let us be that trusted, comprehensive. We'll start to think about planning a little bit. We'll start to think about allocation. We'll start to think about risk. And slowly but surely, a guy would give me maybe $1 million and allow us to report on his 10. And it was a challenge. We'd try to go to some firms and they would say, no, you're not coming in our back door. It just was an interesting time on thinking about how to connect and really start to have a comprehensive overview of a family. Yeah. And that's where we started. And it was pushing rocks uphill. Those first 2, 3, 4 years, unlike today, our space, which is in probably it's maybe certainly not the height. It is an amazing time for the industry. It's been great for clients. And we have so many different levers that we can pull to make us better and stronger every day at doing our job. That didn't exist back in that period. Yep. And so I remembered simply calling Vanguard and calling all of those platforms who used to just walk by my office at Merrill every Monday, Tuesday, Wednesday, Thursday, and saying, guys, you got to come and say hi to me. Like, just come and tell me what's the flow, what's the conversations. Today, there's dedicated teams covering independent RIAs, and it's tremendous the support that we get today. And this just didn't happen overnight. It's been happening over the last 20, 30 years. But the support we get today versus what it felt like and looked like in those early days, completely different.
Yeah, don't imagine. Even the last 5 years, we've seen a massive jump. And certainly the last 10 years is probably where we can trace back the hockey stick growth of the independent space because of platform providers and support platforms and technology. What I'm just going through my mind right now is you were super, super early to the party in 2004 as a higher end wirehouse advisor, breaking away, going independent, and not going independent through Raymond James or Private Ledger, which is now LPL, or any of those even legacy independent broker dealers, and certainly not going to Morgan Stanley or a firm like that. You didn't really have that many clients that initially came with you if you had 23 million or so.
No, it was a handful. These are still with me today. Unfortunately, we've lost some of them, but I still have a couple of them. And when we do get-togethers, we always highlight them or introduce them before having a client event. A gentleman, his name is Ron. He's literally been with me since I was probably 22 years old.
Oh my goodness. That's amazing.
And we've worked for his family through a couple transitions, through a lot of tough markets. It's really quite special to have those kind of relationships that have stayed with us. Those core families are all with us today. Unfortunately, we've lost some of the patriarch and matriarchs, but we have the kids and some of that next generation and even down to G3. But it was a very challenging period. It comes from my dad he built an amazing agricultural farming business. And I think it was just part of my DNA. I always say I was super lucky to have great people around me and certainly give me guidance and pick me up when I fell down. When I look back to those early days, Mike Fusco, who ran Merrill Lynch, he was really the leader that was brought in to bring these teams over and retired off the Merrill platform. I had him as an advisory board member. I had a couple other key gentlemen who I certainly trusted and had been around the investment management side of the business. I remember having my quarterly meetings and catching up with them. They were just a good sounding board to push me along, give me some confidence, but it was challenging. And we started to see growth. The reporting concept was a big help. And then through the crisis, unfortunately, so much trust was lost across Wall Street. And at that time, it really allowed us to start seeing some wind behind our backs a little bit on,
That's interesting.
adding assets to the Schwab platform. I think we talk a little bit about when we got to Schwab. I'm sure we weren't the first, but we ended up on their kind of advisory board for brokers in transition to Schwab. And we still laugh about it today. Schwab really didn't know how to bring an advisor from Merrill over to their platform. Like they just didn't know the right steps. And so we helped basically through our challenges and through some of the horrors, we helped really give that feedback and shape what obviously has been an amazing growth spurt for both of those platforms. But it was really fun to be part of that. And some of the guys today that you and I both know out there as really the thought leaders, I remember this, and I sometimes do have regrets, but I did what I said I was going to do. We were so early that we were really part of this initial, do we want to be part of the Schwab referral, Fidelity referral networks? And I remember, and this was certainly one of my mistakes, is I said, gosh, I'd love to do it, but I really want to focus on high net worth or ultra high net worth families. And if I do this, I have to take all relationships. So smaller, larger. And looking back, obviously, that was maybe a little bit of a mistake on my part of just the tremendous amount of growth at some of those platforms that did choose to go down that path. It would be a different business today. And so what I'm really proud of is we did it on our own. We did it maybe the hard way,
Definitely the hard way.
but we did it under our terms. And if I look back to my business plan, it's exactly what I thought I was going to build, which was a platform that could deliver all services to a unique part of the sector of the investor consumer. And we did it. We absolutely have done it. Could we be bigger? Yeah. Could we be smaller? Maybe. But we did it. And we added the right team members. And it's been a journey. And there have been some real hard days, but we did it with the right people. And where we are today is just, I'm super proud of it.
Yeah, amazing. So let's talk a little bit about some of I call it like the hallmark or the differentiators from Camden, the first RIA that you helped start and run. So I know from just reading online, reading in your bio that Camden's private fund platform was really what it became known for. So now like everyone's talking about alternatives, and the number of firms that talk about unique access to the private markets is pretty crazy right now. Back then, that wasn't the case. What was it that you and your partners believed about private investments at that time that others missed?
Yeah. I think our client, this really helped us put the process in motion, which was we had a large real estate based client group. The one thing they trust and have confidence in is cash flows. As we think back to 2010, 11, we were coming out of the crisis. It was difficult for people to believe in, looking back, obviously it feels easy, but at that time, as people looked at pushing assets out into their allocation, cash flow, it felt like it would be a place of trust. And so we started to think maybe buying a public REIT isn't the right way to do it. Maybe we should look at a real estate platform that could deliver predictable cash flows with durability and appropriate risk management. And so we had some friends that were in the business. And so we first started with structures that allowed us to build a good cash flow, not hitting home runs, but at that time, maybe trying to make an 8 to 9 with maybe a 1 to 3 year duration. So something to think about, how can we look at our fixed income or look at our yield? How can we add that to a portfolio? And that was really our first step. We didn't start it with maybe traditional private equity. We didn't start it with venture. We really started it around the durability of cash flows around real estate. And so that was our first step. And it worked. It was great. And I was also, I think, aware of what was going on at some of the other platforms, because now we're starting to see, this is post-crisis, you're starting to see some growth in the industry. Some of the larger teams are now breaking away. And so you're starting to just, if you're really watching some of their actions, you're starting to see that privates are starting to be a bigger part of the day-to-day conversation. The other part that was helpful to me was I'm in my mid-50s today. I was growing up, and this would be important for any advisor as they're growing through their chapters, but I was around good people who were at larger platforms who were now starting to think about their breakaway and maybe leaving a large private equity platform and launching their first boutique, smaller, focused private real estate, private equity, private credit, whatever that might be. And so I had a unique seat at the table of being friends or having relationships around those thought leaders that were also innovative in their departure of, hey, I'm leaving big to go boutique and deliver what I think is the right offering, the right risk management solution, the right investment product for the upper high net worth, ultra high net worth, maybe even institutional client. And that momentum picked up. And so thinking 2011, we started putting the building blocks together. Our first couple funds were around 2011, 12. And then it really started to take off. We started to think about the diversity of it, started to build on some of those relationships. And that was really a big part of our growth at Camden over that kind of 10-year run, I guess you would say. We were starting family office work. The complexity of a client was starting to evolve at that time as well. And there's lots of talk of family office, and everybody pays bills and everybody helps track some day-to-day big picture planning for a family. But really getting into the weeds, there's probably only a handful of true platforms that deliver and can solve that complexity of running a single family office through a shared ecosystem like we do today at Validus.
Yeah, I'm with you. Yeah, it seems more prolific today. And I agree. There's so many firms that use those buzzwords, multifamily office, much fewer that deliver on it. But you guys were definitely early to it in 2012, 2013 or so.
Today, obviously, you're hearing this next mile or this next step is the Blackstones and everybody having access into retirement accounts and starting to listen. Privates are not for everybody, and there are challenges with them. The last 2 or 3 years have been difficult in private equity, even private real estate. Rates impacted some of that, certainly the activity, certainly M&A, certainly some of the transactions are slowing and have been almost zero here for a couple of years in some parts of the market. So there are challenges at times. Our job is to build a diversified, a thoughtful risk management solution for families. And we do have a lot of families. I think as families' wealth evolves, many of our large families don't really want to have a lot of directional exposure. They just don't either trust or believe or really just want to move aside or step aside from that volatility that does come from a market that can be liquid on any given day. And I think privates allow a lot of our investors to be better. It allows them to buy over time and be a seller over time as a thoughtful GP manages the current cycle, both for investing and for cycling through or distributing on an exit, versus obviously depending on the advisor to make that decision across a liquid market. Emotions can run hot and cold on both sides. I think having that opportunity to think about your building blocks of whether it's private credit or whether it's private real estate or whether it's sports or whether it's traditional venture or private equity solutions, it allows someone to think about, I can be very disciplined over the next 2, 3, 4 years and put money to work, knowing that I'm going to slowly transition those dollars back and either recycle them into the same manager or think about new opportunities that come. The other big part, which we all know, is businesses are staying private a lot longer. And so how do you access, everybody's talks about it every day, but how would you access the next NVIDIA? And maybe NVIDIA is a one and done. Maybe it is the one unicorn that will never happen again. So those are some of the things I think clients appreciate. I think it's something they're interested in. I also think our clients are entrepreneurs. They are thought leaders and a genius at their business. They needed to be to get to where they are today. And the relationships that we've built across our private platform allows them to have a seat at the table differently than the large known names today. But having a chance to be part of the idea, part of the struggle, part of the success, it all comes together. I can tell you on a day-to-day, we have exposure to the S&P, we have exposure to the Russell 1000 growth. Those have been unbelievable and amazing, successful indices this last 10-year period.
You did something that fairly few people do. You broke away in like a very challenging time with really, it was like the Wild West then. There's nothing there to guide you or help you. Built up Camden Capital to be one of the major firms in the industry. And then you broke away to basically run it back and do it again.
Yep.
So to the extent you're able to talk about the thought process and why you decided to leave a firm that you helped start to put the hard work in to build again. Can you talk a little bit about that dynamic?
Yeah, I think it was a great chapter. And I was able to build an amazing team, and our clients are as amazing as the team members. We've been really blessed with having deep relationships, very trusted relationships that we've built over this long period of time. And if I think about all the success we had at Camden, unfortunately at times, and it can happen, we've got partnerships, we've got relationships. Sometimes the communication maybe breaks down, or you just start to drift apart on really the alignment or really where you see the future. And those are common. And I would just let people know that when those things occur, you've got to believe in yourself. There should be, and always is, an opportunity to exit and to make the hard decision. And some days I think I probably should have just done it earlier, but I call this my third chapter. I'm going to do this, God willing, for as long as I can. I really enjoy the relationship part, and I enjoy solving the day-to-day issues that come up. And I love the investing part, particularly on the private side of the portfolio. And I was starting to be sensitive and was struggling with how do I think about our clients for the next 10, 15 years? And how do I think about my G2 and G3 inside my team? And what could we do differently that would maybe get everybody out pulling the wagon equally or together to allow, certainly at some point, a transition? But I was excited about that next chapter, and I wanted to see that out. And so we did the hard thing, which was make a change. And as we know in this industry, it's hard. Clients, as deep of relationships we had, it did scare them a little bit. Lewis, you talk to advisors and teams every day. It is scary to do it. And our business is to keep clients confident, keep them focused on the future, having them think about their families, think about their careers, think about their charitable contributions if that's important. And so it's always hard to do, but we did it once. So I was like, gosh, guys, we can do it again. But it's still hard. And I look back, what we've accomplished in the last 3 years, if you'd have told me that day one, I might have even said, I don't know if we could do that. But it's been an amazing 3-year period. The team stepped up. We've doubled the size. We're growing appropriately. We are excited about the future. And most importantly, I've got a team that's aligned, and they know where they stand, and they know where they are, and they know they have a vision together with me as their CEO.
Yeah, it's amazing. Where you are now, 3 years into running Validus, your second RIA firm, is an amazing accomplishment. What is it that you think Validus does uniquely well right now? Is it your positioning? Is it your ideal client profile? Is it the services? And I know on your website, you talk about the only at Validus promise. Like maybe all that is a component of it, but what would you say makes you guys different?
I think our clients make us better every day. And when you start to provide a service for families that have had success and sold a business for 50, 100, 200, 300, up the scale, what comes along with that are some incredible people and some incredible leaders that think differently than maybe some, and that second level thinker. And I think that's helped us a lot. While I believe we have that in our team, how do we look around the corner? How do we think about, this just came to mind, but I remember being in my early 20s at Merrill. A client called me one day and said, John, I just want you to understand that commissions are going to zero and you'll be working at McDonald's if you don't figure it out. And I was like, what is he talking about? We're charging 1% for commissions. We've got this amazing research. That's never going away. How could that go away? And sure enough, it went away. And so when we think about what we do today is a combination of our team's intellect, skill set, and the day-to-day push and support that comes from our client base. And there are amazing reporting. We use Adipar. We've landed at Adipar. Adipar is great at what they do. We decided, in addition to that, to build a solution in-house around private reporting that thinks about the complexities that fall into place and impact not only the client, the investor, the tax team that's doing the compliance and signing a return. And so we built a model, and we did this in-house, and the team really we listened to certainly suggestions and guidance from some of our clients. And of course, we've been doing this for so long, we knew there had to be a better way. And so we've built a reporting model that tells a better story of exactly what's occurred across not only funds that we've initiated or recommended, but if someone has done something direct, we can drop it into that platform. So we've got a more sophisticated solution that we think is bar none better than certainly most of the industry. What that allows us to do then is tie that into a cash flow spreadsheet or analysis that allows us to forecast out over the next 2 years. That gives us better guidance on what capital calls look like, what distributions look like. Certainly income in most cases is pretty predictable. And so we can tie that together so that we can plan better. A lot of families that we initially get introduced to have somewhat lost control of what do I have out there? Where is it in its duration? And in many cases, we do sit on the advisory board of some of certainly the platforms that we are investing in and have built relationships in. So we have a very deep understanding of really what that duration and timing looks like. We then bring that over to the estimates and the tax preparation that goes into privates. And so if we think about those three pieces on our private solution, it allows our customer and our client to be very confident on kind of where I am in the planning stage. It gives us an understanding of, on a tax provider, of either the headaches or the challenges that comes from collecting data. And we can push all of that out, which brings both our tax team and our client together and allows us to be a very important part of that relationship and hopefully create support and efficiencies that really go and drop down onto that tax team to make them say, gosh, the privates are so challenging for many of our teams that we work for, families, but Validus is leading that and has really created an opportunity to deliver on the service side, which allows all of us to make better decisions. We've been able to do that, and it's been a big support, and I think it gives clients that confidence that they need to make obviously the right decision, and it allows the tax team to be better prepared as we think about quarterlies and annual tax payments.
A big part of your growth strategy going forward, aside from your impressive organic growth, is to start recruiting experienced advisors and to acquire practices. What would make a successful advisor choose Validus over a competitor or choose Validus over just doing it on their own like you've done before?
Let's just think about it the next 5-10 years. The industry is certainly getting more mature. I think there's a little bit of a vacancy of youth coming into the business. So there's a little bit of aging happening. There's a lot of independent advisors that haven't really thought about this next level. What does it look like as they sunset? I think some are probably going to have some challenges on what is that business truly worth. And then you have the amazing leadership that's happened in some of these large now national brands. And I think advisors today, unlike in '04, you can go a lot of different ways. I always tell guys, this country boy from Iowa did it. So if I can do it, guys, anybody can do it. You got to believe in yourself. But I think today you could go to a national brand, unbelievable opportunity, large, big scale. You could certainly go to some of these quasi-independent models that allow you to maybe still hold broker dealer, maybe still have if you added some commission business, but you've got plenty of opportunities and they're all focused on that, certainly client success. What I think makes us unique is we are built like a national brand in the sense of our deliverables. I think the skill set of the team, how we look around corners, how we think about problems. And what I'm really excited about is we are going to be an opportunity for some of those advisors. It's not going to be for everybody, but we're going to be a place that those advisors can come and sit down at this family table and be a part of amazing growth over this next 5-10 years and have a place to think about their own G2, maybe their G3, both on the client side and on their team side. And I think that's what's going to make us unique. The national brands are amazing, but in my view, there's going to be a little bit of, I'm starting to feel like I'm maybe back at a big wirehouse.
And when you say national brand, you're talking about the mega cap RIAs.
The mega cap RIAs. And listen, unbelievable leaders in the business, but our business is it's evolved. And so you're going to have some challenges with that. And we were fortunate the other day, this is going back now over the last 18 months, but we're starting to see some very skilled people who were sitting at some of those platforms that are now just waking up saying, gosh, I'm skilled. I'm entering a peak of my career. How do I hook on to, or how do I be part of that next chapter. And Validus really fits, I think, that exciting moment in time. We've gone through some of the hard lessons. We've built a business that has opportunities across privates. It has amazing solutions across family office. And those, as I put those things together, led by our service initiative, it's going to be a place I think resonates with high quality teams and advisors as they think about how do they take care of their business and their family for the rest of their career.
I like it. The concept of joining something kind of ground floor and building something together versus choosing just to build something on your own, which plenty of people do, or doing something where it's more like a mercenary culture. Like I'm just going to build my team, but I don't really necessarily want to be part of something bigger than myself. I just want to run my business and serve my clients. So it sounds like obviously not going to be for everyone, but like what you said, it took you a lot of hard lessons, a lot of time, a lot of money to build what you did. So if you have the opportunity to join and get a piece of the action and kind of be along for the ride, I see the appeal for sure.
Yeah, there's a time for that. And there's different advisors and everybody's a little different in their own legacy and chapter. And so we're excited about it. And we know it's challenging. It's not going to be easy. There's a lot of options. It's very competitive. And so we're going to be thoughtful about it, but we're going to find the right people. And hopefully you and I are working together in the future too, but it's going to be a really fun next 5-10 years, hopefully 15, 20, but we'll see. We'll see how things go.
Awesome. One more question to take us home today. What's one thing you do differently if you were starting a business again? Maybe a mistake you made, or if you had a do-over, what's a suggestion that you'd make now and something that you made a mistake on in the past that you would do over again?
We talked a little bit about it earlier. I was just a little bit too headstrong early on, and I just didn't probably trust in my delegate. I wanted to be involved in everything. If you want to build a successful business, and certainly one that has scale, you've got to have confidence and trust in your team members. Early on, I was a little overreaching, and I just didn't trust that as much. I was young. Maybe I was just scared that I know how hard it is to get a family to become a client. I think I just was scared. And so I certainly stressed or ruined some early relationships with some of my team because I just didn't have confidence maybe in myself to have that trust. And probably one of my biggest mistakes early. When my team listens to this, I think they're going to say yes. I know they will. But today I've grown, I've matured. I think it's the one skill set that when you look at great CEOs and great leaders is they have that trust and confidence in their team. And I'm blessed with amazing people, the leadership and the tenacity that they have. This business takes a lot of that. We all know how hard it is. And so that's probably one of the biggest things that I know my wife's happy about that. And I know my team members are, but I just have so much more confidence and so much more belief in the individuals and the team members. And that makes a big difference. Our clients can feel it. They've got great ownership and they feel like they're part of the solution and they're part of the success.
Well said. Well, that was a very humble and I think self-reflective answer. So I appreciate that. This has been a fun episode. It's not every day you get to meet someone who's broken away not once, but twice. And also to the first time you did it, I can't even imagine what it was like to go from Merrill P. Big to start an RIA.
It was a little lonely, Louis, but boy, has it changed. It's so fun to look back. What a movement the industry has had. And it's created so many great opportunities for individuals. And Louis, you guys have watched the business grow from your side. It's a lot of fun. And listen, the momentum is going to continue. This is a great growth business. I have young people come in here every day, whether internships or want to talk about the business. And I'm so excited to share it with them. I think people should look at the industry. It's got a great place. Obviously today, you can be part of a team. Back in my early days, you were on your own and that's hard. Today, you can be part of sitting alongside so many great thought leaders in this industry. And if you can get that chance or that opportunity, you're going to learn a lot, you're going to grow, and you can become a great advisor.
I'll appreciate your time and wisdom. And yeah, I feel like 3 years from now, we have this conversation. We're going to look back and be like, the industry was so different. It was so grim back in 2025. So no doubt we're in a period of innovation and growth.
Let's put the calendar and we'll make sure we talk about certainly what's happened and it'll be fun to do.
You got it, John. Thanks again.
All right. Thanks, Louis. Take care.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibility seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I stay or should I go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.